The International Energy Agency has declared that the U.S.-Israel conflict with Iran is the most disruptive event in global energy supplies in history. For U.S. natural gas consumers, this conflict isn't just a Middle East story, it's a global gas shock that might ultimately filter back into domestic prices over time. Hello, I'm Teri Viswanath, the energy economist at CoBank. And to make sense of the pricing implications of a possible future of very strong international demand for domestically produced gas, I'm joined by my friend Jack Weixel. He's the Senior Director of Energy Analysis at the consultancy East Daily Analytics. Welcome, Jack.
Thanks, Terry. Glad to be here.
Hey, so the fighting has disrupted LNG traffic through the Strait of Hormuz, which normally handles about a fifth of global LNG trade, and that's hit Qatar first and hardest. When the Qatari LNG goes offline, there's really no swing supply elsewhere that can step in quickly. As a result, global buyers are scrambling and they're turning to U.S. LNG as a marginal balancing resource. At the moment, Jack, we have a supply moat that keeps consumers relatively buffered from these international events. But how might that change in the future?
Great question. At the moment, if we look at the U.S. Gulf Coast, we are constrained on our capacity to be able to deliver more LNG. So basically, every export facility, every liquefaction facility down on the U.S. Gulf Coast is either at capacity or even above capacity, and we're liquefying about 19 BCF a day of gas, which are at record levels. And you mentioned supply moat, right? The reason why U.S. has not seen its prices balloon to over $20 or $30 per MMBTU is because unlike Europe or Asia, we have enough production to take care of domestic demand, plus this 19 BCF a day of liquefaction export demand.
But Jack, how much is this going to increase? Because I think this year is a big year and we're going to see those numbers ratchet higher. So let's talk a little bit about what the expectation is between maybe now and 2030 in terms of that LNG demand.
Sure. Yeah. So in the LNG market, if you're going to build a new facility, you need a supply purchase agreement with an offtaker, right? In 2025, the U.S. developers saw over 12 BCF of SPAs, those supply purchase agreements, basically turn into final investment decision or FID. So between now and 2030, there's about 15 BCF a day of incremental feed gas capacity come online. The majority, the vast share of it is already spoken for. A lot of Asian buyers, certainly a mix of European buyers, and then you have your multinational traders, for example, Gunvor or Cheniere, that have also spoken for this capacity. So I'm not saying it's a constrained market, but it is a very competitive market to secure those U.S. molecules.
Wow. And so as we turn back to the domestic market, the factors that are going to influence certainly higher demand, but there are some other factors that are going to influence domestic price formation. Jack, I think we've gone through a bit of a dry spell with regard to large interstate pipeline development, and that has strong implications with regard to basis, right?
Oh, for sure. Yeah, there are constraints, and where you have constraints means you have low prices in a producing area and in high prices in a market area. But there's a lot of development coming online. Between now and 2030, there's nearly 10 BCF a day of incremental capacity to unlock Permian gas, right? There's another roughly 4.5 BCF a day of what I call intra-regional pipeline expansions in the Northeast to unlock the Marcellus and Utica plays, right? And then there are expansions between the Northeast and the Southeast to take more gas down into the Carolinas and Georgia and Florida to service, basically Transco Zone 4 or Station 85, which is always at a premium to Henry. And so you get about another 4 or 5 BCF a day of deliverability there. So midstreamers are really, they're kind of coming in either ahead of time or just on time to be able to deliver, what is cheaper bottled up gas.
That's really helpful. And as we start to think about the factors that are driving basis, let's talk about these in order. So let's start off with our mid-continent, our Midwest pricing. Jack,
Mhm.
what's set in store for buyers in the Midwest?
It's funny, a mix of things, right? And it actually has to do with a very kind of far away, uh, kind of captive market on the west coast of British Columbia. So you've got LNG Canada, which is a new facility that's running at about 1.5 BCF a day, a new source of demand. And that could potentially steal away gas that traditionally flows from Canada into the Midwest. So interesting development there. LNG Canada has also been proposed and is working out a deal to have a phase two LNG facility on the west coast of British Columbia, which could pull even more gas away from the Midwest. So
Interesting.
whereas MidCon prices have, at least in 2025, were relatively inexpensive, right? There's upward price pressure on the Midwest. Now, there are some proposed pipelines that could take care of that. One to mention is Boardwalk's Borealis project, which is a 2 BCF a day greenfield pipeline that's going to go east to west across Ohio, which could have some more deliverability. So it's being looked at anywhere where there's basically a potential price blowout. Trust me, the midstreamers are there looking to see what can I build into that.
And Jack, that's interesting because I think the same developments that would mean less gas coming into the Midwest, so Chicago no longer a dumping ground, also might have implications for the Western markets because that is also an important source for that market as well, correct?
Right. Yep.
Yeah.
And
And
actually, yeah, it's funny you mentioned that, right? Because with the overthrust expansion that Williams put into place earlier, late last year, right? They're actually opening up their ability to deliver to Northern California because Northern California has been a price premium, right? So there's a handful of projects that want to go to Northern California. There's a large one called the Great Basin Pipeline, which wants to go into Reno to serve data center demand. And so, yeah, like you said, Chicago is no longer a dumping ground, and there's competition for those Western molecules, whether it be Canada or the U.S. Mountain West.
how about our traditional Eastern markets? So the Eastern markets have benefited from Marcellus shale gas, but are we seeing some changes occur in that market?
Yeah, there's there are a number of projects that have been proposed that are FID to deliver gas into Northern Virginia. Certainly, one of note is Williams Power Express project. Right. There's also Williams also just received permission and has actually began construction on NESE, or the Northeast Supply Enhancement Project, which is going to basically deliver molecules, Marcellus and Utica molecules, across into like the tri-state and Long Island areas, right? That's going to be a controversial build, of course. I do expect that we'll see some, lawsuits and protest activity around that. But yeah, I mean, you can gasify a lot of the Northeast, still with the exception of New England, of course.
Of course. And it's fascinating because you mentioned Northern Virginia is kind of where we're targeting. We also see activity occur, bringing the customer out to where the resource is, which is out in West Texas. So Permian, not only the pipeline takeaway, but also seeing some data center projects. But
Yeah.
generally in the Gulf, what are your sense in terms of the Gulf? We're seeing a lot of volatility occur in the Gulf. I think LNG is certainly part of that picture. But what do you make of Gulf-based pricing?
Well, so I tend to think of it, and this is not an LNG pun, but a high tide lifts all boats, right? Or all vessels. So you open up that capacity out of the Permian. That helps your Waha basis price become unconstrained, and so that price gets a little healthier, right? You move a lot of that gas to two places: Agua Dulce, which is not a particularly liquid market, but also Houston Ship Channel and Katy area. And so to the extent that Katy and Houston Ship Channel can absorb that gas, those two basis points basically come together, right? Now you still have constraints between Houston Ship Channel and Henry Hub, or the Gillis market area in southern Louisiana, right? So you are building. There are proposals to build more pipeline between Houston Ship Channel and Henry Hub as well, to kind of even out that price swing. It's not like Waha is going to pull even with Henry Hub, but it'll get closer because it has more ability to deliver gas from west to east.
That's really helpful. And, Jack, I think just generally as we kind of close out this segment, I think it's important for us to take stock that this market appears at a minimum to have a floor that seems to be rising, but certainly a lot more fireworks. Basis all of a sudden is back on the table and seems to be an interesting mark to take a look at. Would you say?
Yes. In 25, we experienced the Henry Hub as an island effect, right? Where there was so much localized LNG demand around there that floor that you're referencing is probably right around $3 per MMBTU, right? Now we've had a soft spring, right? No weather to speak of in February, March, and April, right?
Strong storage.
Yeah,
right?
Strong storage. Yeah, exactly. And so, if that $3 floor, call it, can hold, it's going to get tested this summer when you layer in incremental LNG demand, and then also, potentially elevated, kind of structurally incented power demand from, emerging data centers and also residential and commercial demand.
That's fascinating. Hey, Jack, I want to thank you so much for joining this interview for our customers to hear. We appreciate your insights as always. And for our customers, make sure that you're keeping an eye on natural gas prices. They are no longer boring.
Yeah. Pleasure. My pleasure, Teri. Thanks for having me.